All right, welcome to Talk Tickers. Today, we are diving deep into the fourth quarter earnings call for an absolute icon, Levi Strauss & Co. Now, they put up some really solid numbers, but the market's reaction? Kind of lukewarm. So let's get into it and figure out what's really going on here.
So, right out of the gate, Levi's came out strong with a nice earnings beat. They reported an adjusted earnings per share of 41 cents, and that was a full 2 cents ahead of what analysts were predicting. You gotta love a clean beat on the bottom line.
And it wasn't just about profits. The top line, their revenue, also came in pretty hot, hitting almost $1.77 billion. That blew past the forecasts by a good $53 million. So you've got better than expected sales and better than expected profit. A pretty solid report card.
But here's where the story gets a little weird. You see those strong numbers, and you'd expect the stock to pop, right? Well, it barely moved. We're talking only about a 2% climb after hours. That's a very cautious reaction. So the big question for us is, if the results looked so good, what's holding this stock back?
To really understand what's going on, you have to start with the biggest positive, and that is Levi's incredible direct-to-consumer business. They call it DTC. This whole strategic pivot away from just relying on other stores to sell their stuff, well, it is clearly paying off.
And check this out. It's not just some small side project. Their direct-to-consumer channel now makes up 49%, almost half of all their revenue in the fourth quarter. I mean, think about that. Their business is basically split right down the middle now between selling directly to you and me and selling through department stores.
In this slide, this is where you see the real energy. The DTC business grew at a whopping 10% organically. Now compare that to the whole company, which grew at 5%. That's double the growth rate. It's not just a part of the business anymore, it's the engine that's pulling this entire train forward.
So what's actually powering all this growth? Well, it's not just one thing. First, their e-commerce is just on fire, up 22%. They're also really successfully expanding beyond just jeans into this whole denim lifestyle idea. Their tops business, for example, is seeing double-digit growth. And on top of all that, they're pushing into more expensive, premium products with their new Blue Tab collection, and it seems like people are really loving it.
Okay, so the DTC story is obviously fantastic, but it's not the whole story. To understand why the market is kind of tapping the brakes, we have to look at the other side of the coin, the guidance for the future and some of the pressures that are hitting their profits.
This right here, this slide shows the whole conflict perfectly. It's like a tug-of-war. On one side, you have the past, that really solid Q4 performance, a clear win. But on the other side, you've got the future, the guidance for next year, which came in just a little bit short of what everyone was hoping for. And as you know, investors are always looking ahead, and they saw a potential speed bump.
And let's break it down to see exactly what the issue is. The revenue guidance? That was fine, totally in line. But look at the adjusted EPS. They're forecasting between $1.40 and $1.46. Well, the Wall Street consensus was closer to $1.48. It's not a huge miss, but it's enough to signal that future profit growth might be a little weaker than the market was making in.
So, why the weaker outlook? It really boils down to this: a margin squeeze. Management was super clear about 3 main challenges. First, tariffs are expected to hit their gross margins by about 1.5%. Second, they're facing a higher tax rate, which is going to take about 4 cents off their EPS. And finally, they've got some temporary, but real costs as they upgrade their distribution network in the US.
But look, management isn't just sitting there and taking it. They laid out a really clear playbook for how they're going to fight back against these headwinds and protect their bottom line.
Their whole response is built on these 3 key pillars. First up, simplify the company by getting rid of businesses that aren't core to their brand. Second, double down on that premiumization strategy to get people to pay more for their products. And third, keep sending cash back to shareholders to keep the stock price supported.
Now, a really important part of that third pillar is something called an accelerated share repurchase, or an ASR. They just announced a $200 million one. So what is that? Simply put, it's a way for a company to buy back a huge chunk of its own stock all at once. It's a massive signal from management that they believe their own stock is undervalued. It's a big confidence vote.
So if you're an investor, you want to keep an eye on a few key things coming up. That ASR program was just announced. Then in the first quarter, we expect them to finalize the sale of what's left of the Dockers brand. And then by the second half of next year, those pesky distribution costs should start to go away, which could give a really nice boost to their margins.
All right, let's bring it all home. We've seen the powerful DTC growth, we understand the margin challenges that are holding things back, and we've walked through management's game plan. So let's put it all together in our final segment, the next call. This is our take on where Levi's goes from here.
So, the big question is, after weighing all the pros and cons, what are our final call on Levi's stock?
You know, we think the next quarter's results are probably going to land right in line with the cautious guidance management just gave. All eyes are going to be on what they say about gross margins and tariffs. Because of that uncertainty, we expect the stock to probably trade sideways for a little while. Just kind of be range-bound, until the market sees real proof that those margins are getting better. And that leads us to our final rating, market perform. The DTC execution is absolutely fantastic, but it's being canceled out by those external pressures. For right now, the stock seems pretty fairly valued.
So what's the trade idea here? We actually see a really interesting paired trade. The idea is to go long on Levi's stock, but at the same time go short on one of their weaker competitors. You know, a company without a strong brand that relies way more on department stores. The beauty of this trade is that it's designed to capture what makes Levi's so strong, that brand and that DTC channel, while protecting you from any broader weakness in the apparel market.
And of course, we always have to say it, this is not financial advice. That's it for this Talk Tickers analysis. We'll see you on the next call.